Hello and welcome to this week's episode of Nucleus Investment Insights. Today we have a special friend of the show, Jonathan Rochford, and the episode is called When a Distressed Debt Manager Meets an Economic Bust. If you've been listening to Nucleus Investment Insights for a while, you will have picked up on our concerns about the incredible pace of rate hikes and the potential for central banks to take that too far and push economies into recession. Property data out of China this week has again been very concerning, and there are other areas we're going to discuss today like US commercial property, high yield bonds, and loss-making businesses that we'll also touch on. Today, we'll pull all of these pieces of the jigsaw puzzle together, and as always, we'll discuss the investment implications at the end. Just so listeners are aware, all the major themes we talk about in this podcast are taken into account and reflected in our active portfolios. Just a quick reminder, this podcast is general advice and is not intended to be specific to your situation. If you do want to discuss your personal financial situation, you can go to nucleuswealth.com/contact and you can book a call with me or one of the advice team. Today, as always, we have Nucleus Wealth's co-founder and chief investment officer, Damien Klassen. Damo, welcome.
Hi, Sam.
Excellent. And today we also have Jonathan Rochford, the founder and portfolio manager at Narrow Road Capital. Jonathan, you've had an incredible career, and I think you'll be the best person to give listeners a bit of information about your background and what you do at Narrow Road Capital. So welcome, and the stage is yours.
Thanks very much, Sam. So Jonathan from Narrow Road Capital. I'm the founder and portfolio manager at the business. Look after about $400 million in assets in the debt space, primarily securitization and property lending for institutions, not-for-profits and family offices. And in some ways, you could perhaps describe what I do as the exciting end of investment grade or the boring end of private debt. But a bit of crossover there between the two, but it's something we might get to later, the private debt market being an interesting space at the moment.
Nice one. Thanks for that, Jonathan. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Just a little bit of housekeeping. We are live every Thursday at 12:30 Australian Eastern Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. Just want to reiterate again from last week, we are going to be in Sydney on the 24th and the 25th of this month. So next week, we are a finalist for the IMAP Innovation Award, which is the Institute of Managed Account Professionals. So if anyone's over in Sydney, they want to get in touch, they want to have a meeting, feel free to reach out to us and we'll be happy to meet up. So that's all the housekeeping out of the way. So Damo, over to you to get the ball rolling.
Yeah, thanks. So look, we want to get Jonathan. We've got to get Jonathan on sort of once a year or so at least, just to have a touch base, because I think one of the things in the listed market that we don't see a lot of is some of the sort of I guess the stuff that's going on in the unlisted and particularly the debt space. We're very equity focused and we look at government bonds and cash, but it's great to get a view from somebody who's seeing things from a different angle. And there's a lot of stuff going on at the moment. We've seen some really rapid interest rates, and you'd expect at some point that that's going to start affecting people as they're refinancing, and you're going to start seeing some people who are really struggling to pay the higher rates. And so we thought Jonathan's a good person to get to let us know how warm the bath is getting and what he's seeing from his end. So I guess I might start with let's start in Australia as a big picture. So we had and back, I guess, because you do a fair bit in the residential side in terms of the bridging and things like that for quite not sort of your $200,000 apartment in Hobart. I want to buy another one. It's more than a couple of $1 million overseas. I'm an overseas investor with a $5 million
thing that I want to switch or whatever it is.
Yeah.
And I guess where I'm coming from this is, so we had fixed rates at 2%. They're all rolling off. What are your thoughts in terms of how that market's looking and what you're seeing and how much distress and I guess what we're hearing from others is it seems to be a lot of people going, well, I had a 25-year mortgage, now I've got a 35-year mortgage or a 30-year mortgage, and I've just extended payments or whatever it is.
Yeah, no, it's a very interesting question, and I guess the simple answer is with residential mortgages, there has been a surprisingly small increase in arrears. Securitization industry, banks were certainly expecting increases of 4% flowing through to show a lot more pain than we have seen. And one of the differences, banks did a lot of fixed rate mortgages, so there is some back ending of that. It flows through particularly over the next 12 months. But in the securitization space, 95+% of people who borrowed have borrowed floating. So they have seen basically all of that 400 basis points put through already. And the arrears levels certainly have gone up, but they've just gone up to what is normal average levels. So arrears were quite low. The government threw bucket loads of money at people during COVID. People had a lot of money in their pockets. Mortgages were generally, people were getting ahead on their payments. And so now we're in a position where, yes, they've gone up, but they've gone up to levels that we just think are normal when we look over 10, 20 years.
Yeah. So when we run our affordability stats, though, we sort of look at just saying, okay, how much is mortgage versus rent, or how much is a mortgage versus incomes? They certainly seem to be very elevated. If not at all-time highs. Mostly, well, the rent one, it's not as all-time highs because the rents are shooting up and helping you out on that front. But yeah. So I guess. Your thoughts on that? Is that just a sort of a matter of, well, we're a richer country now, people maybe can afford to pay more for the set of products?
Generally, no. And that's there's two big issues with housing affordability. One is that a person with the median income cannot afford a house, particularly in Sydney. A new block of land, house on it, if you're looking at a family-sized house, circa $900,000. If you're turning up trying to borrow $700,000, $800,000, you could be talking about after-tax money, 60 grand a year in repayments. That is just not feasible for a family on the median income. So that's definitely a huge affordability problem. And at the low end, people on welfare or minimum wage jobs, rent is skyrocketing. And so for them, it's extremely painful.
Yeah.
Now, both of those things, how do you explain what's going on? In short, the population is growing at over 2% a year. That is much, much faster than other OECD nations. We are a huge outlier there. And the building industry simply cannot build fast enough to keep up with that.
Actually, so I think Leith, who's a frequent on this podcast as well, he was highlighting that Australia is actually already in the top. I think it's the top 3 in terms of OECD countries in terms of the proportion, the rate that we're increasing our housing stock. So we're actually already building as fast as anyone. It's just we're bringing people in faster, and so the ability to scale up is very hard.
The Productivity Commission's done reports on this, and they've said Australia is underbuilt at a residential level relative to other OECD nations, but we are building very, very rapidly. The problem is the population is just going faster than the building industry, and it was fast under sort of Howard and Costello from then onwards.
Yep.
But what's happened since COVID is just smashing the lights out. And the current Labor government is if you want to get political on it, they're, I think, making a call. There are more votes in house prices being steady or going up than there are in affordable housing.
Yep.
So you bring the population in, house prices, there's a strong tailwind from the population growth. There's the view that that's good for them as a government being re-elected, so that's the position they're taking. And all the stuff about how do we make housing affordable, that's really a fig leaf.
Yeah, and to be fair as well, the Liberals had exactly the same policy, or if anything, sort of they'd sort of hide it. But I think the statement even was house prices will always be higher under a Liberal government.
So typically we would see population growth to 350, 400,000 a year. Now it's well over 500,000.
Yeah.
So it's just that extra push. And yes, the population did decline a little during COVID. Students went home, backpackers went home. So yes, there was a decline, but the country adjusted to that. We took up more space. So the number of residents per property dropped a little. So we took up the space. Now we're just getting hit with this wave of people arriving in a building industry that's having all sorts of problems.
Yeah.
And the idea that you can, somehow create qualified bricklayers and plumbers and electricians and architects and town planners and magically start building the housing stock much faster than you ever have, that's just not feasible.
Yeah. Well, that's an interesting thing, is like saying, your thought experiment is to say, but for people who are like, oh no, all population growth is good, is go, well, we can grab some boats and sail around to third world countries and just pick people up and bring them over here, and we could have 10 million people a year, and we could all just make houses, we could all be making houses over here, and that'd get everyone employed. And you're like, yeah, but what are we doing it for? That's a question of,
do you want to have 20% of the population in the construction industry? Do you think that's a reasonable thing to do? Do you think it's good for the economy, the environment?
Yeah.
Is it good for quality of life? Of course not. It's terrible.
Yeah. And so realistically, though, this is the world we're living in.
Yes, it is.
So where does the pressure build the most, I guess? So one side that goes, okay, we've raised interest rates. Actually, people start not being able to afford their houses. They start to lose their jobs, and then eventually, we see a downturn in the housing market, and that brings back some affordability. The flip side is you go, actually, no, we just keep pouring people in, and rents skyrocket, so that okay, maybe people can't afford it, but actually what we've got is effectively a class of whatever 25-30% of people who are spending 70% of their incomes in order to finance the people that have borrowed and all the other property. And so it's I guess you end up with a cost of living crisis for people who are renting, or you end up with a bunch of defaults. Or is there another place where we can get rid of the pressure can escape?
Yeah. Look, there are no easy answers. I guess at this stage, the unemployment rate is barely moving upwards. So we are simply just not seeing that pressure that you would usually associate with a recession. Unemployment rate rising by 2, 3, 4%.
Yep.
That then puts downward pressure on wages, and then you can get costs falling across the whole of the economy. Now, if you didn't have the population growth and you did have those effects, then the building industry would be able to catch up, build the capacity it needed to.
Yep.
I don't think the government's going to budge on migration, so that's not going to happen. You're just going to have to keep building to keep up with the population. In terms of defaults and losses, you're in that situation where if the population keeps growing, the house prices just have this constant tailwind. So the people who lose their jobs, if they're absolutely stuck, can't get another job, can't find another way to get income, cut their expenses, they put the property on the market, they sell it, and unless they bought right around the peak, they're probably getting out flat or with a profit. So it's uncomfortable. The chance of getting back in is going to be really tough. But economically, if you're getting out at break even, a bit of a loss or a profit, economically that feels okay.
Yeah. Well, and I guess based on the numbers that we sort of run on affordability, you rent to mortgage payments is sort of, depending upon where you are, sort of 150 to 200%, depending on. So you probably, if you're paying $1,500 a week in a mortgage, you're back to $1,000 a week to rent the same place, and so you sort of theoretically you're picking up a benefit.
Yeah, I think probably the other thing you've got to throw into that sort of analysis is that obviously the increased interest rates flow through into higher mortgage payments, but as an investor, you've got that one hand of, you've got this tailwind of migration, and it's unlikely the government's going to change that. On the other hand, you say, well, anything that's got debt, from term deposits up to, riskier, more interesting things, the yields just shot up by 400 basis points. So your rental yield looks pathetic.
Yeah.
It always looked bad. Now it looks really bad.
Yeah.
And you're back to betting on capital gains to get you home as a worthwhile investment.
Yeah, absolutely. Now, and I guess from a demand point of view, I guess I'm talking consumer demand point of view here. The other side of this is that you go, okay, most of the people who are spending money are the younger people, and most people who are saving money are the older people. So it sort of seems as if we're ending up in this situation where we're raising interest rates to try to slow down a housing market that can't slow down because we're pouring people in. We're punishing the younger people who are, because we're all basically saying to the younger people, okay, you're going to spend more of your income on rent or a new house if you just get kids or whatever it is. And the older people who aren't spending money, here's some, you're probably either debt free or close to it and have large investments, and now you can have some more income.
Yes.
So does that mean, and so they don't spend the money, and so does that mean, to me that sort of says, well, is the RBA, do you think the RBA has recognition of this problem? Because I guess there's came out with comments that were saying, oh, well, more people will just have to move in with each other, and and comments around we'll have to get the unemployment rate up. Do you think they understand that, or do you think they're more sort of into the classic, we're looking at our Phillips curve and therefore we need to get to this level and we just need to keep raising interest rates to try and slow this down?
Yeah, so you're absolutely spot on with that sort of spending dichotomy. And I can say from my own extended family, that's exactly what's happening. So younger people with a mortgage, cost of mortgage has gone up, cost of living's gone up, things are much tighter than they were. Older people with savings, the returns you're getting on your savings has gone up substantially, so you can spend more. And that's absolutely, the data from one of the major banks showed that. Sort of 65 plus, they've got more money to spend and they're happy to spend, but younger people having to cut back. So that dynamic is absolutely going on. When you start to think through the way housing is owned in Australia, it's roughly splits up into three groups of a third each, roughly. So a third is owned with a mortgage, a third is owned outright, no mortgage, and a third is rented.
Yeah.
And that third that's rented is investment properties. They've probably got debt against them. So they're feeling some of the debt, but there is kind of a way most people think about that, which is to say, well, they're investors, it's a second, third, fourth property. If they need to sell it and they get out, break even, or make a profit, well, that's fine. We don't worry about them too much. So you then got this 1/3 group that's got a mortgage on their property. Of that group, you sort of go through and you say, well, who's got plenty of equity in the property? Who's got a low mortgage? Who didn't borrow the maximum amount they could? Who bought years ago and they've seen the property price go up? And you kind of might end up then, of that 1/3, you've maybe got about a third that's left where they did buy near the peak, they did borrow an awful lot, and they are stretching quite a lot. So when you're looking at this kind of all of the housing that's out there and you're trying to jam this sort of slowdown on the economy into maybe a third of a third, 10 to 15% perhaps, you're doing painful things to a fairly small group of people to try and get the overall economy to slow down.
Yeah.
Now, that's just the consumer side. On the business side, though, the stupid stuff has stopped happening. So if you think of venture capital, high growth, low profitability companies, that stuff has all stopped. So that takes a big chunk out of the economy that was right on the fringe of the margins. That's come out of the economy. So that naturally slows things down a bit.
Yeah, and the part that I'm interested in that part is, and we alluded a little bit to private equity before, but is this idea that the amount of money invested in private equity over the last 5 years was just a factor of, I can't remember what the stats are, 2 or 3 times what it was in prior things. So there's a lot of money poured into this, and then a lot of debt on top of that.
Yes.
But I think for the large part, a lot of the debt was sort of locked away for, it seems like company lending has extended over the last 5 years. So a lot of companies actually got their locked away for a while. And so we've got the same issue there, that there might actually be a bunch of companies that are like, okay, we bought this thing, it was earning $100. We managed to get debt at 4%. And so, yeah, and we're making a $1 profit. But actually now, if we had to refinance, we're doing it at 8%. Now we're making a $3 loss. But we don't need to refinance, so everything's good for the moment until the day we have to roll over.
Yeah. So that's a really good point. People talk about the maturity wall that's coming up, and that is, when does this debt that's been taken out mature, and will it be interest rate resetting at that point, or has it been interest rate resetting along the way? So a really good place to think about this is the US high yield bond market and leveraged loan market. These are companies that carry sub-investment grade ratings, BB, single B, triple C predominantly. This is where private equity goes to get their funding when they buy something, gear it up, and hope to make a big profit at the end. We are definitely starting to see defaults come through in that space in the US. The market here is far less developed, and it's a lot quieter, it's a lot more private, so it's tricky to say here. But in the US, definitely high yield leverage loan defaults are ramping up.
Okay, and so when you say private within Australia, so I'm a private equity guy. I want to find an Australian business, I want to buy that out, leverage the crap out of it, and then cut out all my capex for a few years and then flog it to somebody. Now I'm into year 3 of that. I was ready to flog it. Actually, valuations have fallen, so I can't do it. Where have I got my loans from? Have I gone to the US to get that, or am I more likely to come to people like you or sort of the private family offices and stuff like that? Where's my money come from, and where's the pressure now on me to say, okay, you know, your business isn't worth what it is. You've got to sell it, or you've got to do something else to refinance.
So there's a couple of main places you go to in Australia if you've done a private equity deal and you want the debt financing. If you are more sort of triple B financing, so the leverage is significant but not, really stretching.
And for readers, that's an investment grade, the bottom end.
Sorry, double B is the top end of sub-investment grade.
So
triple B is the bottom end of investment grade.
Yeah, exactly. Yeah, you're right at the bottom of it. So you said triple B?
Maybe triple B, but private equity is probably more starting at double B. Okay. Do like a bit more debt. You probably go to the major banks in Australia, you can get some funding off them. You might also join in some of the large sort of institutional funding groups as well. Those ones are almost all floating rate. You may have bought some swaps, you probably haven't. And so they've taken the floating rate increases already. Now, if you're really racy, if you buy something in Australia that's really racy and you want lots and lots of debt, then pretty much it's off to the US. There are a few groups that do that stuff here, but not so much.
And so, and if I'm getting the US debt though, could I have got the fixed rates or not?
You may have. So the US high yield bond market, you lock in the rate as part of it. It's a fixed rate product. The US leveraged loan market is a floating rate market. So you've got that dichotomy of high yield bond market. You might still have 3 years to your rate's going to increase. Leveraged loan market, you've already followed it. And if you have funded just for the leveraged loan market, you've really put a lot of debt in there. Your interest coverage ratio was tight. Well, your interest payments are double or triple. Well, you could be up against the wall right now.
Which is why we're seeing the
defaults come through.
Okay, but what you're saying is in Australia though, it's going to be more. You're waiting for your creditors to start saying, okay, knock on your door and
what's probably more likely in Australia is either if the business continues in okay format, that it's not turned into a loss-making business, the customers haven't fallen away.
Well, I guess think of it as is that example I used you where it's like, okay, I'm making on my $100, I'm making $5, but actually I've geared it so much that I used to be making a profit, but now I'm not. So I'm still, the business itself is fine. It's just it's me. I'm the problem that I geared it too much.
So in that situation, so you might be heading to insolvency. Somewhere along the journey, though, there should have been covenants on the loan, and your lenders will come in and say, look, you're banging up against your covenants or you breached your covenants. You need to put some more equity into this deal. If you don't put equity in, then you're off to insolvency, and the administrators, receivers will figure it out. But if you tip more equity in, okay, you're back on an even keel, keep going. Okay, rates have gone up again. Your business hasn't sort of grown into it. Okay, tip some more equity in to keep it going. So if you haven't borrowed excessively, you do have runway. The covenants will kick in at an early stage as an early warning signal to the banks and other lenders. And then you'll be having those discussions. Are you going to put more equity in, or do we have to, push you hard to make something?
Okay, but so and in terms of if you've got your investment clock and midnight's when everyone turns into a pumpkin, it sounds like we're still it's after 6, but we're not sort of 2 minutes to midnight or anything on this.
No.
Despite the big increase in interest rates. Yeah.
There are certainly patches where we're seeing defaults come through in much bigger waves. So US commercial property, there's a whole bunch of stuff blowing up there. The drop in property prices is enormous. So lenders are being handed the keys on a whole bunch of properties.
Yeah.
The Chinese market, we're seeing a lot of property trouble.
Let's get to China. I'll separate China for a minute because I do want to get to that. But so why do you think? Because you hear a lot about the US commercial market, and valuations have dropped, and certainly in the listed market as well. We keep a good eye on that because it used to be a much bigger part of the market, and then it's shrunk a lot. So why do you think that affected the US more than it affected Australia?
Yeah, so a couple of things sort of underpin that. The US investment environment generally are much more risk tolerant. In Australia, we're much more risk averse.
Yeah.
And you see that in the way people lend money, invest money. The sort of crazy venture capital stuff that you see in the US, let's just fund this company. There was a lot less of that. Like some of the examples would be grocery delivery companies. Like, how are you ever going to make money? Like, it costs you $15-20 to deliver groceries. You're charging $15 for the groceries. Like, it's something that they double the price to have the groceries delivered. It was a service that just never made sense, and so there's a bunch of those shutting down. That sort of stuff we haven't seen nearly as much aggression in Australia for those sorts of things.
How about the commercial property side though?
Yeah,
we do have a big commercial property market.
So 2 parts to that aggression. One is, how much do you build? And in the US, there's a lot more speculative building, a lot more people who are willing to sort of go with the cycles and just, hey, things are up, things are happy, let's go for it, let's build something. And also the debt side, you can just get more leverage.
Yeah.
So you look, for instance, at our listed companies, and a whole bunch of them are reporting its earnings season. A lot of them, the gearing's in the 20 to 30 or 30 to 40% ratio.
Well, and we had the near-death experience in the financial crisis for a lot of
Absolutely.
So.
Yeah, I mean, guys who had 50% leverage, prices are coming down. They had to go to the markets and raise equity 2 or 3 times. And they've been burnt. There's still some memory.
Yeah.
In the US, one of the areas that's really struggling is where they've used securitization, and they put layer after layer of debt in there. And so it might have been only 20 or 30% of equity in the deal.
Right.
And now if you're talking about some of the office towers, some of the retail space, you've seen tenants just walk out the door. The value of that's gone down by 50 to 80%. And if you only had 20 or 30% equity in the deal, there's not even close to 20 equity left. It's long gone. It's now a case of how badly do the debt investors get burnt?
Yeah. Now, and so and it's this dichotomy, isn't it, where we've got these commercial markets, crashing, and the residential market sort of holding up all right. And I guess the obvious question for most people is, well, why don't you just convert the commercial into residential? And over to you on that.
Yeah, well, what I've read from the people who are the engineers, that the biggest issue is commercial is set up in a way where often the floor plates are large. So that means there's a core, there's lifts in the middle, and then there's a lot of space out to the windows. So firstly, the infrastructure, the electricity, the water, and the lifts are set up in a certain way, and often that is not a good way to set them up for residential.
Well, I think legally you can't, because you need windows or whatever it is. And so
that's the big thing about the floor plates. So if the floor plates are smaller, you've got more window space relative to the floor plate, then it is easier to convert. But when you have these deep floors where the lift well might be 30 or 40 metres, how do you turn that into a residential apartment where the bedrooms are just going to have no sunlight? You might have one room that has sunlight.
Yeah.
How do you do that? Will it comply? And one of the things about Australia is, for the good thing, there's nice amenity to that. The bad thing is it means it's much more expensive.
Yeah.
So that conversion story is, some of the engineers will say there's 10 or 20% of office buildings that are good candidates for conversion, but the vast majority, the floor plates are too big.
And one other group that I was listening to, it was basically cutting holes out in the middle of the buildings.
Yeah.
You're like, yeah, okay, it works, but it's obviously not a cheap exercise to say, yeah, we're just going to slice out, whatever it is, 20% of the middle of the building and create windows facing inwards. Yeah.
Yes. Well, it's one way to solve the problem, but you just lost 20% of your floor space, and it costs a lot of money to do that sort of structural work.
Yeah, it's a big engineering process. Yeah, okay. So we had a commercial bust in the early 90s in Australia. Is this the type of thing you think is potential for the US and I guess for Australia as well, or is it sort of more you think is this well contained in the famous words of Mr. Bernanke?
Yeah, well, certainly in the US, it's not contained. It is falling apart in ways. So, what are the other things that leads to the difference in the way things are set up? I think the numbers I've seen, and these are a bit old, is that there's about 2.5 times the commercial retail space in the US per population as there is in Australia. So they build a lot more space. So when there's a downturn, there's a lot more empty space.
Yeah.
So that's why you're hearing stories about prices for office and retail falling 50 to 80%. The tenants have all left. There's no income, and it's now what can we do with the space? And we're going to repurpose it, and it's going to be at a much lower price point.
Yeah.
So, for instance, office is a bit trickier, but if it's retail, can you put big box type stuff in there? But the rent's going to be much lower. Some of the interesting conversions that I've seen in the US is they might put a college in there, and the rent's very low because they just want someone to come in and take the space. But you've got the college there, so now you've got a gym, you've got a supermarket or a mini mart there. You can put in a hairdresser and other sort of basic services around it because you've got all these people showing up 5 days a week.
Yeah, and I was thinking as well, it's probably a lot more than the typical office as well. The typical office, you're like, here's my space, everyone needs the space, but it's the same people every time versus, I've got one group coming in now, and then I've got people coming in at night, and I've got whatever it is, 3 bunches and what have you.
So in a way, retail's a bit easier to solve than office.
Yeah.
Office, there's a lot more talk of the floor plates are too big. We just need to dynamite the thing, and then we'll put some residential in its place.
Yeah. Interesting.
Hey guys, we're just going to go to a quick sales message, and then we've got a question after that. We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. So guys, I've got a question. So with office space in the US, Jonathan, you mentioned some of it has fallen 50% to 80%. That's obviously not the majority, but is there likely to be contagion into other parts of the economy with those depreciation in prices?
Particularly regional banking sector?
Yeah, so regional bank is the key one. And I guess there's arguments back and forth on this. I've seen some data saying, some of the regional banks are chock-a-block with commercial property exposure, and others saying, no, you're exaggerating the exposure. I'm not an analyst, but you need your banking analysts in the US who are looking at these groups and understanding, how much do they hold that is office and retail versus all the other sort of consumer corporate lending that they do. But certainly there is a big warning light on that sector. They have ramped up their exposure at exactly the wrong part of the cycle to the wrong part of the sector mix.
And I think they naturally have a higher to that in any way, I think. Relative to, say, JP Morgan or something that's got banking stuff everywhere.
Correct.
Yeah, your regional banks are just smaller, and so what do? I take deposits and I lend it to property. And
certainly it's that lack of I guess, risk expertise as well that comes in with the regional banks. And we saw those failures, the high-profile failures. And they simply didn't do the basics of saying, what's our floating rate exposure, what's our fixed rate exposure, and let's match them up. No. They were going long on fixed rate exposure.
Right, sure. Yeah, so it's now we're talking Silicon Valley Bank and those ones. But I guess in a way, I'm looking at those ones and going, well, that's not a crisis of solvency. That was a crisis of, I've just got my hedging wrong. Like, you know what I mean? Like in the end, I'm like, I'm taking deposits to stick them in government bonds. How can I possibly go broke? It's like, well, yeah, you managed it. Well done.
Yes.
whereas then it's so those ones to me, that's like it's an issue, but it's not like the tip of the problem with the commercial. The problem with commercial is still yet to come.
Yeah, I agree that they're different. I guess I would make the link though that it's about quality of risk management.
Yes.
And so one is interest rate risk, one is credit risk. But if you've got people who are so dumb that they're senior people in a bank and they don't understand interest rate risk, what chance have you got they understand credit risk well?
Yeah,
I'm not backing them.
Well, that's where I do want to get to China, but let me lead into that first. And this idea of private equity is that because there's been the flood of so much more. Do you think, and I guess in your space in particular, do you think that there's been lending? How much lending do you think's been done that shouldn't have been done relative to, say, prior to the financial crisis? So prior to the financial crisis, I guess I'll characterize for you, but I guess saying there was just lending everywhere that shouldn't be done.
Yeah. And
so when the whole thing, when the first card got pulled out, the whole thing collapsed. Is that the case now, or is it it's more constrained and it's actually, there's a chunk of it, but it's not the bulk of the market?
Yeah. So I had the good fortune as part of my career in the GFC to be working at one of the major banks, cleaning up the messes they got involved in. So I think Allco, Babcock and Brown, Centro, those kind of companies, working on those day to day, figuring out how much are we going to get back on these. When I reflect on that and I reflect on what major banks lend to today, it is really hard to find obvious equivalents where people have just lent way too much to businesses that have got a whole bunch of risks that are not well understood.
Right.
In Australia, it's just very hard to see that happening. Where we are seeing stress is obviously construction and property development industry at the moment.
Yep.
And if you want to find the raciest part of that in Australia, that's private debt side. That's family offices and some of the institutional groups lending for construction purposes, lending at higher LVRs. Not as crazy as the US and what they get up to there, but certainly that's the raciest stuff I can kind of see. And we are seeing projects fall over and builders fall over, and there are losses coming through on some of those.
Yeah.
The key difference, though, is a bank balance sheet is leveraged. That's the way they operate. The sort of private debt, family office space, there is almost no leverage in that sort of area.
And so let me just clarify what you mean by that is, so in the leverage part is the bank's taken my deposit, then created more money and created more money. And so if the whole thing unravels, there's lots of, whatever you are, 10 to 1 leverage in terms of that.
Yeah.
Whereas private equity is actually, here's a rich person who's gone, I'm going to spend $1 million, and somebody's come out and said, yeah, I really need to borrow $1 million, and they've basically gone, here you are. So if that falls over, the rich person's lost $1 million, but there's not a flow-on effect of actually the next one loses, and they owe people money and all that stuff.
Yeah, that's correct. I mean, if you look at the major banks here in Australia, it might be something like $6 worth of equity against $100 worth of assets. It's something like that, roughly.
Yeah.
Whereas the stuff I'm doing with my clients and most other people in this sort of lending area, you get $100, you lend $100. There is no leverage from anyone involved in that.
Yeah.
That $100, they could go on to the ASX and buy some shares with it. But they look at the yield, and the sort of more boring stuff I do is kind of 8 to 9%. If you're getting into the racier construction stuff, it might be 12 to 15 for senior. And if it's subordinated, 15 to 20, maybe 15 to 25.
Yeah.
So they're looking at that going, well, if I can do some boring lending at 8%, it's better than a term deposit. Yes, the risk is absolutely different. It's higher, but it's better than a term deposit. And I can't only expect, 7 to 10% off equities in the long term. So 8 off some fairly boring property debt. That sounds pretty good.
Yeah.
So it's really equity money, or it could be equity money.
Right.
There's no leverage. So particularly when you're doing senior lending, you think, well, if you're anywhere near reasonable in senior lending, you're going to recover 70, 80, 90 cents on the dollar when things go wrong. So
the reason for this is because, things worth $100, it's borrowing $70, and the senior stuff's only $20 or $30 of that. And so if something goes wrong, it takes a big loss before you finally have to study into the senior. Is that?
Yeah. So it might be something like you've lent 60% as the senior on the $100. I only work with built property. Other people obviously doing the construction development side. But on the construction development, builder goes broke, costs escalate. So yeah, it's foreseeable you could at 60% eat into the senior debt, but you probably still get from 100 asset value, 100 falls to maybe 50. So you're getting 50 back. You've lent 60.
Yeah,
your recovery rate's pretty good.
Yeah, it's not the end of the world. Okay, so let's go to somewhere where it might be the end of the world. So let's go to China, because I guess what I want to say. So you spoke about Alco and Babcock and Brown, and for me, one of the issues with those guys was, you break open you look at the balance sheet and you go, it doesn't look that bad. And it's not until you dig into the fact that actually there's leverage upon leverage upon leverage upon leverage. And so, this thing that looks like you've got an asset there of $100 actually isn't really an asset. It's $1,000 of asset and $900 of liability, and they're just telling you the difference. So in China, it looks as if that's what's going on at the moment. There's leverage upon leverage upon leverage. You want to? Well, I'll let you do the overview of what you're seeing in China, and particularly the property market, I guess.
Yeah. So probably as a starting point, China is a pretty aggressive market in the way they invest, and particularly the way they lend. Some of the things you see are quite wild. And you just can't think of any equivalents here in Australia in terms of the way they lend money and the things that go wrong. And the level of fraud and the types of fraud that happen seem to be much more common. So you do hear anecdotes of people have gone to 3 or 4 banks with the same property and got loans from all of them, pretending that each of them is the first ranking lender.
Right.
There's been issues with commodities where people will say, we've got X tonnage in this warehouse, and they've had 7 lenders against it. Or they've said they've got the tonnage, they don't have the tonnage, or they've got something in it that's actually not the commodity, it's something that's far cheaper. So the warehouse is full, and if you don't look, you think it's fine, but you do look and you go, hang on, this is not copper, it's something else.
The layer of copper over coal or whatever it is.
Yeah. So
aluminium or something.
all these sorts of things are not uncommon stories in China, and in terms of the way they lend. So their base of how sustainable is this, how badly could it go wrong? The foundations are quite poor. So the risks of a major collapse is much higher. Now, this is where it gets tricky with China, is that because there's a communist government, they have a lot of control over the economy, they are able to kick the can further down the road than in the US or Australia.
Yep.
And so one of the things, and I'm part of this, people have been watching China for the last 10 years going, this is nuts. It's going to break at some point. Just year after year, they're able to kick the can down the road. And the debt levels get higher and higher. The amount of excess infrastructure and excess property gets higher and higher.
And probably safe to say exponentially as well in terms of it. 20 years ago, you go, they took out some debt, but then property value went up, they paid it off. And then the next one, they took it off and they didn't quite pay it off. And then a few years later, they were actually, we've got more debt upon debt. And so the problem's getting worse to a faster rate.
Yeah. So the debt to GDP ratio just keeps shooting up in China. A simple comparison, the debt to GDP ratio in China is like other developed economies, Australia, the US, Europe, etc. But the fundamentals of how to lend money, how their economy is better referred to as an emerging market. They are developing the systems and processes of how to lend money, how to get it back, of how to deal with each other honestly. And so, the foundations are just poor. They've got a lot of debt, but it's not debt on good things in many cases.
Yeah. So within the Chinese, we've characterized over the last few weeks the Chinese property development sector as basically saying we think it's turned into a utility insofar as there's so much debt and they owe so much to creditors and suppliers, and they've taken prepayments on houses they haven't built yet. And so they owe so much that there's actually no way anyone would ever lend. Even just, saying, even if you got rid of the debt tomorrow, just on the other two factors, it'd be hard to find somebody to lend to these companies. Is that now it's effectively the government saying, okay, we'll keep you alive long enough to build the houses people have already paid you for. I don't know whether what your thoughts are on that, is whether we're accurate, inaccurate.
Yeah, look, there's bits of that going on, and there's bits where it has just been stuck for years, and you're like, when is this going to get resolved?
Yeah.
And for emerging markets, it's really common to have these long periods where you're going to wind up the company, you're going to finish doing things. So Evergrande's a situation that's just dragged on for years, and people are like, well, there's no agreement on how to restructure the debt. The estimates of what you might recover come down over time, and people just get more and more pessimistic about the situation. So certainly it's possible that Chinese government steps in, provides assistance and
okay, but let's say Evergrande. Let's use Evergrande though. I guess what I'm saying is they're basically keeping Evergrande alive enough. Like theoretically, if that was a Western country 3 years ago, somebody would have just said, "It's all over. We're selling off everything, and we get what we can, and creditors get 2 cents in the dollar, and if any, and that's it." Whereas Evergrande's been allowed to stay alive despite all these things.
Yeah.
And I guess that's what we're positing, is saying, well, maybe it's just a utility now, and that it's keeping them alive long enough to build the houses they've already been paid for. And I'm saying,
Pull like, yeah, and I guess when you're making those decisions as well, is it actually worth finishing the project? So yes, you might have got 30% of construction done, but you're looking, if you get to the end and you spend the rest of the 70% of the money to finish the project, it's only worth $50, but you spent $70 to finish it.
yeah,
Well, you're better off just leaving it as a shell. So there's a whole bunch of things out of that becomes interesting in a demographic sense, interesting in a political stability sense, because people have taken out loans. It's much more common in China that you take out a loan, you hand over the money to the developer at the start, and they give you a unit a few years down the track.
Yeah.
Well, now they haven't given you a unit, and it doesn't look like they're going to do that. So you're going to the bank saying, I don't want to pay you anymore because I haven't got my unit, and you've got this three-way dispute.
Yeah.
And the bank, as much as it wants to, can try and say, well, you've still got a job, we want to garnish your income and keep it going. But eventually there's enough people in this situation that government officials have got pressure on them and they feel they have to do something.
yeah,
So you've got that sort of problem. You've got young people who are increasingly unemployed. The government doesn't want to tell you the statistics anymore. It's so bad.
So just to clarify that, so China this week or last week has stopped publishing the youth statistics while they review the calculation, and with the view that it's well over 20%. I think it's close to 25 now. Was the last number we saw.
I think 21 was the number recently announced, but the unofficial numbers, some people estimate 40 to 50% youth unemployment.
Yeah. And it seems as if that is largely because a lot of the youth has been to university and then got out of university and they're basically being asked to work in manufacturing jobs that people without degrees have, and they're sort of saying, no, I deserve a good job. Yeah.
And so the government is telling young people, no, you have to take these menial jobs, disregard the education you've got. You need to take this job. It doesn't pay as much as what you expected. You can't afford to buy a house where you expected on this menial salary, but you've got to do it just like previous generations have. And I guess the risk is, and I'm sort of careful in not stretching it too far, but if people get upset in large enough numbers, particularly young people, they get together, they have a protest, and the government cracks down, and that's Tiananmen Square.
Yeah. Well, and then that's one end of it, and the other end is the government says, we really need to distract a lot of people. Maybe we need to start buzzing Taiwan a bit closer, and that'll get us these people, give them something to do. Yeah.
Yes, potentially.
Yeah. So I guess the net effect of that is, it does look like there's enough imbalances there that politically something is going to have to change.
Yeah. So you're regularly seeing big development companies in China fall over. and you're regularly seeing the lenders to those big developing companies fall.
Yes.
So that's a lot of people's savings effectively being wiped out. In a country where, in large part, it was everything goes up mentality. You just buy some assets and it goes up. And you know, there's ups and downs along the way, but certainly there's a huge bet on property. That's the mentality of that country, is to bet on property. Shares, not so much. The Chinese property, the graphs are, get sent around every now and then. It's just a huge part of the Chinese economy. But globally, Chinese property at the current valuations is a huge part of global assets.
Yes. Yeah, absolutely. Yeah. As you and it's that question, isn't it? How much is that for if I'm looking at a country with a bunch of people earning $10,000 US on average, how much should I really value the prices at, and the demographics that look like that look really bad and potentially overstated, even if they look bad.
Yeah. So if you've got a whole bunch of people earning $10,000 and a whole bunch of empty properties you're trying to sell at $500,000, it simply doesn't work.
Yeah. Well, and the other factor, and I guess that's what I was talking about, that leverage upon leverage part, is that we were talking a couple of weeks ago about the Chinese developers, which we sort of dug through, and I think the rough stats was for every dollar of equity, there's $10. This is the top 20, so I'm not picking on anyone. So Country Gardens in there and Evergrande and stuff like that do make it look bad, but they're not particular outliers. Like for every dollar of equity, you've got about $10 worth of debt. Versus in the US, developers is a dollar of equity is about 7 cents of debt. And then you go, the amount of prepayment is about 140% of annual sales. So good. That, and then your debtors and all that sort of stuff is about, you're taking about half a year to pay people on average. So you've got this massive amount of debtors as well. And then you go, well, that's just what we can see.
Yeah.
Like as you alluded to there, the chance of there being off balance sheet liabilities you just don't know about.
Correct. And that's a very common thing, that when companies go down in China, there's a whole bunch of guarantees they've made to other groups, and so you can have quick flow-ons. As someone goes down, that guarantee was relied upon to prop somebody else up, and they go down. But the other thing about China that potentially accelerates things much faster when it gets bad is that a lot of those wealth management products, which I think it's Zonro has got into trouble recently, one of the larger wealth management product originators, is that those are often on 3, 6, 12-month terms. So when people get spooked, that maybe it wasn't the group they bought a wealth management product from, but somebody else and their friends or relatives have got done over in that one, they're like, well, maybe I should pull out this other one.
Yeah.
If people pull their liquidity, it pulls out really quickly. There's not necessarily 3-year loans, and you can finish the project and get the revenues and try and close it all down.
And let's just sort of define these wealth management products. They're typically, as you said, 3, 6, 12 months, where it's like, give me this money for 6 months and I'll give you a 10% interest rate. Is that type of product?
Yeah. I think if you put your money in the bank, you might get like 2 or 3% in China. Whereas if you go to a wealth management product, 6 or 8%, maybe a bit more, is much more common.
Yeah.
So people are simply making that call.
But those wealth management companies would generally then lending the money to property developers.
Well, a whole range of things. Yeah. Sometimes they've been, buying equities. Sometimes they just buy bonds as a way to get some yield. There is a fair bit of property. Some of the wealth management products have been linked to iron ore and coal companies, which have fallen over.
Yeah.
So it is quite diverse in their underlying assets, but property is a big part.
Yeah. So in terms of our we were just talking before the show about saying it feels as if every second day for the last week or 2 weeks we've had some sort of thing about China, which is none of it's been good news.
Yep.
Whether it's Country Garden, going in, or wealth management products, not buying, or property starts down again, and all these stuff. In terms of our getting close to midnight, everyone turns into a pumpkin. It feels as if it's close, but then again, they've managed to push it down the kick can down the road a few times when it felt like it was sort of 11:30.
Yeah.
What are your thoughts on China, and can they? And the second part is this starting to get enough momentum that actually at some stage doesn't matter how China tries, it's too late.
Yeah. So I think what's easier to say is the fundamentals are bad. The fundamentals line up a lot with Japan in the late 80s and early 90s.
Yep.
Aging population, too much debt, property prices are ridiculous. An economy that's really, probably the only thing that doesn't line up well with Japan is Japan got rich, whereas China's kind of moved up the emerging markets table. The cities have become rich, but there's still a lot of regional, provincial poor people. So the country as a whole has only really moved up the emerging market rankings. It hasn't become a developed economy. Versus Japan, where they, obviously were very wealthy at that late 80s, early 90s peak. So it's not hard to sort of look at China and say, is there a 30-year funk ahead of them like Japan has had? Yeah, that's not hard to think about that.
Yeah.
What everybody wants to know, and what's extremely difficult to give an answer to, is, does that start, is it really kicking off now? Does the government intervene and sort of forestall it for another 2 or 3 years? Could they forestall it for another decade? We've had a decade of looking at the fundamentals going, this is terrible. And it's just been allowed to get worse. So that's the really hard part. I can't profess to have an answer. What you can say is the fundamentals have deteriorated increasingly. There's a whole bunch of things that are coming together now that could be the start of, unraveling. But you've got a government that, they will ultimately pay the price, but they can forestall the paying of the price.
Yeah, and I guess there's a part about going, in the past, like when they did it in 2007, sort of the first kick to move things on. They did a reasonable sized kick, but actually it was a pretty big kick at the time. That was a big kick. That the amount of debt that then took 2015 again was even more. The amount of debt during the pandemic was even more. Like, it feels to me as if the amount to actually get a genuine kick is going to be the world's biggest rescue package we've ever seen, and the biggest transfer, I guess, effectively from governments to debt holders and people probably should have lost their money.
Yeah.
And that doesn't seem to be on the cards at the moment. But you're right; it's a question about will they.
Well, like Japan, financial repression is part of the long-term solution that's likely to be used, and that simply is saying inflation will be higher than the return you get on your money at the bank.
Yeah, and China has deflation at the moment.
Well, China has deflation now, so that makes it even trickier to pull that trick off.
Yeah.
But certainly you can have that situation where you cut the rates. They have been cutting rates. They're likely to keep doing it, just keep cutting rates and cutting rates, so that those who have debt, the rate is low enough that perhaps they can just drag on and get a profit maybe 10 years down the track, and then they can pay it off.
Yeah, and in terms of currency, theoretically, you're cutting rates. Everyone else has got higher rates. That sort of spells weakness for Chinese currency, which sort of then would spark more exports. But I guess a lower Chinese economy and more exports is not going to be looked upon favourably by any country around the world who's already saying we're already getting enough Chinese exports. We don't need to make them balance worse.
Yeah, and then there's the issue of friend-shoring and all those other reshoring activities. You don't necessarily bring it back home, but you do say, well, we feel more comfortable with Vietnam or Cambodia or India or
Mexico.
Anyone but China kind of story. How much of that can be shifted around? And I don't say these things lightly. Those things are actually very hard to do. Changing factories, changing supply chains, particularly if China has built up multiple core functions within one supply chain, it's very difficult to pull that all out of one country.
Yeah.
So politicians like to talk about it. It's very hard to do.
Well, I mean, since we've talked about it, China's been is exporting more than they ever did. So it's obviously been, and they're on that front, they're now up to the leading car. They're not number one car exporter. They're pretty close to that from where it was number 5 or 6 now. And and there's this huge investment in, what they call it, it's not cutting edge. I think it's it's non-cutting edge semiconductors. So they're not allowed to do the cutting edge ones because the US won't export them. But the non-cutting edge ones, they're actually seems like they're about to flood the market. Yeah, cheap chips for everything. So
yeah, and an example there, just that you were bringing up with the cars, they're becoming quite dominant in the EV space. So again, there's a whole bunch of things there about refining the commodities, creating the batteries, creating steel and other products that you need. And if you've got a lot of those things in your country, you can hang on to that leadership through the supply chain for a long period of time.
Yeah. Yes, excellent. Okay, so I know we're taking lots of your time. I just that private debt. So in terms of China, then what are your markers that you're watching for that are saying, actually, this is going to be the big one versus no, it's going to shuffle. Sorry, I guess it's more about saying. I guess we're probably saying, so we're on the same page, going, look, it's probably not going to be a massive debt crisis. It's probably more like China more like Japan in the just a long, drawn out process of actually just paying up for it, where you just get money transfers. But what are the things you're watching for to go, no, they're actually just going to throw a whole bunch more stimulus at it and kick the can down the road for another 3 or 4 years?
Yeah, so I think watching with the big developers and wealth management product companies, do they allow the losses to be taken?
Yeah.
And, with the big property developers, they have both local and overseas bonds. They have banks that would have lent to them as well. Wealth management products, that's almost all domestic retail product.
Yeah.
So who are they going to allow to take losses and feel pain? Are they going to?
So foreign investors right now, they're already allowing to take pain. Foreign investors, if you're a foreign investor in one of those things, your money's gone.
Yeah, and certainly, do you protect your banks or do you allow your banks to go? Because if they've got too many exposures to industries that are falling apart, they go down as well.
Yeah.
And when banks go down, that's how you go from a run-of-the-mill recession to a depression is failing banks.
Yeah. Okay. So basically, what you're watching for is how they're treating these big developers and the wealth management products. Is the sort of key part working out.
People being left on their own to take the loss as we would in a capitalist society, or are they intervening because they feel that, hang on, there's too many people who might overthrow the government if we don't do something? Yeah.
Okay. Was there any other big topics? I mean, there's obviously a world of other things going on. Any other big topics that you want to talk about that are sort of pressing in your mind, that are focused on what you're wanting to invest in?
Yeah. I mean, probably a small thing is just the outlook with the RBA, and so I'm slightly bullish in that there might be more rate increases to come.
Yep.
So markets will generally say, no, we're done. This should be it.
Yep.
And then there's a good case to back that up. I think a couple of things to throw in the mix that maybe some people are ignoring. You look at the RBA's own commentary, it says, we think we'll get inflation back in the range in late 2025.
Yep.
2, maybe a bit over 2 years. That's really stretching the rubber band a long, long way.
Yep.
Now, obviously, RBA forecasts, not locked in forecasts. Some people haven't learned that lesson, and they learned it very hard when rate increases came earlier. But the RBA, when it says it'll do something, it doesn't always happen. So we've got to take that with a grain of salt. But it's fair to say, if that's what they really think, and things start coming in a little bit more than that, then they really do have to do something more to bring that down, bring that back into the range of what's reasonable to wait for inflation to be 2 to 3%. I think when you start thinking about what are the key components feeding through inflation and thinking about the medium term for those, key one is wages, and that flows straight through the service industry.
So this is Australia. So this is okay. So just let me pause you on wages for a moment. The RBA is talking about saying, hey, we don't want wage growth too high. Now, wage growth yesterday was 3.6, 3.7, which sort of feels like 2.5% inflation, 1% productivity, 3.5%. That's roughly what we're targeting over the long term. 3.6, 3.7 doesn't sound like it's miles above what we're target is. Like, it all seems to be them, the RBA projecting that, hey, we've got to look out for wage growth is going to be 5%. They're sort of jumping in shadows as opposed to actually, no, we've really seen this.
Yeah, so the minimum wage increase was 5.75%.
Yep.
That flows through to maybe 20% of people who are earning. Now, they are the lower income earners, so it's less than 20% when you look at sort of the dollars.
Yep.
But certainly we are seeing wages sort of in the mid-3 area, but increasingly people are seeing other people get 4 to 5%.
Right.
And it's getting locked in for 3 or 4 years.
Mm.
And that's where it really gets tricky.
Yeah.
Is when you've got low unemployment, you've got the ability for people to push back and say, no, I want more, I'm going to take a job down the street with someone else. And they start getting that 4 to 5 locked in. That is really problematic because you can just look out for 3 years and say, well, that's what's coming through the pipeline in services sector.
Yeah, and companies are going to put their prices up by that much.
They're going to have to.
Yeah.
I think probably other things to throw in the mix, cost of building, cost of rent, that's not contained. That population growth is too high for the building industry to work with.
Yeah, and this is the pushback on that, and I'd add in the energy costs that we're allowing to flow through as well. But on both those, raising interest rates doesn't solve any of that issue. Except you're saying, well, maybe if I send a bunch of people unemployed, like, you know, I guess what I'm saying is if we're talking about a broad demand for goods and services, I'm like, yeah, raise interest rates, people stop buying a bit more, you know, all the margins stop going out as much, blah, 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 and that brings inflation back. Whereas you're saying people don't have somewhere to live, and so they're all bidding over places to get to, or people can't afford to heat their home because prices are too high. Raising interest rates doesn't solve either of those problems.
Yeah, directly, no, it doesn't help, but indirectly it works through the system. So there's both the consumer side of, yes, consumers cut back their spending. Certainly, if you shift from being employed to unemployed, you know, you usually do make a pretty significant cutback in your spending.
Yep.
But it's things like, you know, bonuses and the extras that some people get, they will be cut back as well.
Yep.
So you're getting that, but also on the business side, it's not as much as the RBA ever thought it was, but business investment, you know, there is a link to interest rates, and particularly when interest rates are zero, people are like, hey, can you come up with some idea and I'll give you money and hopefully we'll all make a good return.
Yeah.
But if you can get a TD at 5%, you start saying, well, no, I don't need that equity risk.
Yeah.
I don't need to stretch into venture capital and other things. I'll just stick with something more.
Yeah, and there's a discussion somewhere that there's companies out there that finance at 4%. So I've got a debt for 7-year debt for at 4%, and I've just got some new cash in the door. It's like, well, I actually have to stick that in the bank and make a positive margin on that myself. Yeah. Well, do I need to go out and invest it?
Yeah. And particularly with the equity market still being somewhat elevated, the whole, do you go out and do mergers and acquisitions? That's tricky. If you think your competitors are overvalued, do you take on debt that's expensive to buy them? Well, no, it used to be debt was really cheap and valuations were still stretched, but, you know, at least the debt was cheap and you could lock it in and you could kind of have some time to work with it, whereas now there's no more cheap debt. Everybody knows the cash rate's 4.1% and you add your margin on top of that.
Yeah. Right. Okay. So danger for you in your mind then is rates tick up a little bit further.
Yeah. So I guess it's not impossible to see rates another 1 or 2 increases, and I wouldn't say it's likely, but you know, it is possible when we look back at history, when inflation had got to the levels that it did, and it's taken interest rates getting over 5% to really clamp things down.
Yeah.
So we are seeing the employment numbers are softening today. We are seeing consumer spending softening, but it is possible that we just need to do a decent bit more, not just one more.
Yeah. Excellent. Sam, have you got any?
We're just going to go to the second sales message, and then we're going to go to question of the week. We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. Okay, so now we have our question of the week. This is for viewers to have some discussion in the comment section over the coming days. So the question for the week is, how long until bad debts become an issue for markets? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. We've obviously talked about pretty much the investment implications as we've been discussing the podcast today, but I just want to throw out a couple of ideas of how to actually play these market themes that are unfolding. You know, if you're a long-term equity investor and you think markets are going to head south because of the things discussed today, you know, you could add in some extra defensive stocks or some extra quality stocks to try to shield any downturn. So just a couple of ideas there. As you would have heard in the sales message, there's around 100 different screens and tilts to choose from. So you really got the ability to customize your portfolio within the realm of us making the investments and doing the investing on your behalf. So that almost wraps us up today. But just before we wrap it up, I'd just like to give Jonathan an opportunity just to tell the viewers a little bit more about Narrow Road Capital and how they can get in touch. So, Jonathan, the stage is all yours.
Thanks very much. So you're welcome to jump on the Narrow Road Capital website. You can sign up there for the monthly articles, monthly wrap-up. One thing I do every month is a wrap-up of media I'm reading that's interesting across economics, finance, politics, and just other areas. That can be something, it's a bit of fun, but it's also interesting. And so when we talk about some of these data points, often they'll get a mention in that monthly wrap-up. So you're welcome to sign up through the website for that. I also post my articles on LinkedIn and Livewire, so you can find me there as well. And if you want to get in contact, you can do that through the website or through LinkedIn is probably the easiest place to find me.
For wholesale investors.
Yeah. So I probably should say work with family office, not-for-profits, institutional investors, and clients start at 10 mil looking to put to work in the debt space. So don't have any sort of retail products available. In the past life, I've managed sort of pooled funds, and the stuff I do is illiquid. So pooled funds, liquid assets, the ability to redeem your money within a day or a week, that generally does not end well.
Yeah, and the idea is on this, as I said, you get a higher return for locking your money up as opposed to saying if you want your money at call, go to a bank or pick some government bonds or something.
Yeah, absolutely. Most of what my clients get paid for is illiquidity and a bit of complexity. The actual credit risk in a lot of the investments we do is not particularly high. You don't expect, looking through history, to lose a lot.
Yep.
But it's the fact that you can't get out. And so I'll give you a classic example of the comparison there is, if you're invested in the listed hybrids of the major banks, you'll get about bank bills plus, it's about roughly 250 on average at the moment. It varies between sort of 200, 250 at times. So all in 6.5. The sorts of things I do for my clients usually start at an 8% return, a lot of stuff in that 8 to 9% band. And those are things that, in my view, are much, much lower risk than, that sort of tier one hybrid preference share risk with the major banks. So the key difference is one's listed on the stock exchange. You can trade in and out of it every business day.
Yep.
One's not listed on exchange. You put your money in, you could be there for a year or 3 years. Less risk, more return, but lower liquidity. You've got to make that trade-off.
Yeah. Excellent. Thanks, Jonathan. Sam?
Thank you, Jonathan. Thanks, Damo. That's pretty much us for today. So, we look forward to having you back on the show again soon, and we'll continue to tell the unfolding story. Cheers, guys. So we hope you get some value out of this podcast. If you do, it would really help us if you hit the subscribe button now. This will help us get the message out to more people. We really enjoy what we do, and we want to continue to put out great content for our listeners and clients. If you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. And we also put out a lot of other content in addition to this podcast. We write regular articles that are featured in most major Australian publications. And we also have the Nucleus Wealth Empower podcast that you can find on the YouTube channel as well. So you can get all this in our weekly Nucleus news at nucleuswealth.com. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, drop it in the comments section below or send us an email at contact@nucleuswealth.com. So for myself, Damien, Jonathan, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.